Hi, I'm John Asbury. I'm the Chief Executive of Atlantic Union Bank. We're based in Richmond, Virginia, and we're a mid-sized bank. I'm an 87 finance grad out of Virginia Tech. Over the course of my career, I've been all over the country. And as I think about my experience at Virginia Tech and what it did for me, it really initially gave me the tool set, the understanding, the technical skills that I needed to begin my career and be successful. And I went into a training program at a bank called Wachovia that is no more, where I was the first Virginia Tech graduate ever. And I was up against people from Duke and Chapel Hill, Emory, Wake Forest. And what I immediately learned even back then was how well I had been schooled. And so I'm deeply grateful for the fundamental underpinnings. Also, my career choice of being a banker was in part inspired by Dr. George Morgan. I was his student. I took his banking class. And I am from Radford. Believe it or not, people are from the area. So Hokie, true and true.
Thank you, John. Viral, any words?
Yes. Hi, I'm Viral. I'm a professor of finance at NYU Stern School of Business. My stock goes up whenever there is banking stress around. That's like a short...
That's why you're smiling. I see. Okay. Yeah.
But I'm very grateful to Vijay and Raman. I've known them over the years, and Vijay invited me to do the panel, and it's my absolute delight to be here with all of you.
Thank you, Viral. George?
Thank you. Welcome, everyone. I'm the so-called Truist Professor of Finance. This is my 39th year. I appreciate Vijay giving me the opportunity to have these 39 years of fabulous adventure and experience with a lot of you in the audience and a lot of Hokies. So glad to be here.
And we'll go over to this side, Mike.
My name's Mike Clarke. I was an 83 finance grad. And Virginia Tech was extremely influential in my career. It gave me the idea of what I wanted to do as a career, as well as the technical skills to execute on it. And a lot of it goes back to George Morgan. He must have been 12 years old.
Yeah, 12 and a half, maybe.
And I took commercial banking with him. We played the bank game. And in that same year, I also had a speaker, and the guy was the name of Jim Rakes. He was the CEO of National Bank of Blacksburg. Young guy, very successful. And I thought, I want to be like that guy.
Lauren?
Hi, everyone. My name is Lauren Lynch. I'm a senior studying finance and accounting. I'm also co-CEO of Basis, which faculty advisor is Dr. Morgan. I'm also going full-time at Bank of America in investment banking this summer.
And Jim.
Hi, everybody. I'm Jim Young. I'm the Global Chief Data Officer for AIG, so I'm a little bit of the oddball here. I'm not in a finance career, maybe traditionally anymore, and I'm also in the property casualty insurance space, not the banking space. But what I will say, I'm a 92 grad of the Pamplin Finance School from Virginia Tech. And I've been in financial services my whole career, so in banking, and then eventually morphed over into P&C insurance. So everything I learned in school gave me the underpinnings, both the technical and quantitative skills, as well as just the business acumen and understanding of risk management and how that applies in different business models. And that's been so important and still important today. And by the way, no matter how far you get in your career, people are going to ask you the ROI on whatever it is you're doing. So remember that.
We're going to talk about the stress on the banking system. And so I'm going to turn to my neighbor here, John, and ask you, why is this stressful situation different from other times when we've had financial and banking stress?
Thank you, Dean. This is different. I'm a 35-year career banker. Until last month, I would have said banks fail for one reason only. That is credit losses. They make bad loans and they exhaust their capital, typically in deep recessions. That is not what happened. I think we've seen that there is another option. This was a classic asset-liability mismatch, and this is something that financial people need to pay attention to. In the case, what both of these banks had in common, the two failures, Silicon Valley Bank, Signature Bank, these were non-traditional banks doing non-traditional things with very concentrated strategies, very concentrated bases of clients, executing an explosive growth rate strategy on an unstable deposit base. These are bad combinations for publicly insured banks that are taking the public's funds with FDIC insurance and putting them to work. Now, what happened at Silicon Valley Bank, they grew their deposits by over $100 billion in a year and a half. And they treated it like the money that's in your grandmother's checking account. They assumed it would be there forever. So this was clearly an outcome of the pandemic, the surge of deposits that was created by government stimulus. Venture capital poured billions of dollars into early stage startup technology funds, reportedly half of which banked at Silicon Valley Bank. So $100 billion comes in, the tide rolls in over a year and a half. What do? They park 57% of the bank's assets in term securities, not 30-year bonds, 5, 6-year, 7-year bonds.
Government securities?
Government securities, sure. There was nothing wrong with the nature of the securities they purchased, but the point is they purchased too much of them. The average percentage of assets for a top 100 bank in securities is about 20%. They put 57% in under the assumption that this surge, which turned out to be a bubble of deposits, would be there forever. The tide comes in, the tide goes out, they find themselves pinched for liquidity. Unfortunately, we had a historically quick run-up in short-term interest rates. You know what happens with a fixed-rate instrument. Rates go up, market value goes down. They liquidated $21 billion of their securities, which was only about a quarter of them, at a $1.8 billion loss on a Wednesday. Blew a capital hole in the bank, said, don't worry, tomorrow we're raising $2.25 billion of fresh common equity. At that point in time, the venture capitalists who were really controlling most of the client base, these technology companies, began to take a closer look and realize they were sitting on $15 billion of unrealized losses in their held-to-maturity securities and had a freak out. The next morning, Peter Thiel, the venture capitalist, goes on Twitter, says, I'm pulling all my money out. They all know each other. The bank run begins. The capital raise fails. That company failed the next day. Signature Bank had nothing to do with the asset-liability mismatch, but in the aftermath of the failure, the shocking failure of Silicon Valley Bank, the market turns its attention to who else looks like this. Well, the number one bank in America that had the highest percentage of uninsured deposits above FDIC limits at 86% was Signature Bank out of New York, which used to be a New York real estate developers bank, but they executed an explosive growth strategy, becoming one of two banks for cryptocurrency exchanges. And all of a sudden, there was a loss of confidence as these New York real estate developers realized, oh my God, we are exposed to this crypto bank. Silicon just failed, and guess what? There was a bank called Silvergate the same week that was the other crypto bank that didn't fail but voluntarily closed because of the disruption in the market. So bottom line, they pulled their money out. Silicon Valley Bank had 85% of deposits uninsured. For a top 100 bank, the typical, quote, uninsured deposit amount would be about 34%. So it was a perfect storm, but these are non-traditional banks executing non-traditional strategies, explosive growth rates, unstable deposit bases. This is not your bank that you're dealing with. This is not representative of the industry. The American banking system is fine. There is no banking crisis. But this did set off a crisis in confidence.
Yeah, I think I largely agree with many things that John just pointed out. But I want to highlight three things which I think are somewhat different this time. So I've been studying banking crises for a while. I like to go back and look at what happened in the 30s, what happened in the 80s. And I find that sort of history rhymes in financial crisis. It doesn't sort of exactly repeat itself because institutions are constantly evolving, regulations are evolving, central bank policies, regulatory policies are evolving. And so when I looked at these bank failures, two or three things stood out for me. The first is the one that I want to emphasize the most, which is that this banking stress, and I'm calling it stress rather than a crisis. I agree with John.
I agree with that assessment.
Yeah. That this banking
yes,
stress
that's what
is
it says, stress.
Stress.
Sorry.
Thank you.
This has sort of happened on the back of a very unprecedented monetary expansion by the Federal Reserve. If you look at Fed's balance sheet size, it sort of exploded by between $2.5 to $3 trillion in a very, very short period of time. Depending on when you start, it's almost $4 trillion. And what's a bit underappreciated is that everyone talks about quantitative easing as an expansion in the size of the central bank's balance sheet. But what is also true that when Fed expands its balance sheet, it's also the commercial banking that expands at the same time.
Correct.
And it's worth spending a little bit of time on understanding why that happens. So what does Fed do to expand its balance sheet? It goes to the market and purchases treasuries or mortgage-backed securities, which are guaranteed by Fannie Mae, Freddie Mac, and the like. Now, typically, these securities are either on the balance sheets of banks or they are in the balance sheets of non-bank financial institutions such as hedge funds, mutual funds, pension funds, insurance companies, family offices, be as it may. Now, when the Fed purchases these securities, the reserves which the Fed credits the system with go on the balance sheet of commercial banks such as that of John. Now, if I was a pension fund that sold my securities in this quantitative easing operation, I get a credit into my deposit account with the bank. Okay? And so the commercial bank balance sheet has expanded on the left side with reserves, and on the right-hand side, it gets a deposit that now belongs to this non-bank financial institution. So one question that's worth asking is, why did we get this explosive growth in the uninsured deposits in the banking system? Now, of course, some of it is related to wealth creation that has happened on the back of QE and the fiscal stimulus, but a very big part of the monetary creation in the banking system is simply this transformation, which is that the Fed is expanding its balance sheet, and in parallel, there's an expansion of the commercial bank balance sheet, and a lot of this is financed with uninsured deposits. And so, in my view, a little bit of this comes back to the doorsteps of the Fed, in my view, which is that this is actually a part of the policy that's actually being implemented by the Fed post the pandemic, and they are, of course, trying to unwind it, but it's not that easy to unwind. So that's point number one. I think point number two, John already alluded to this, is that I would throw a little bit of wrinkle into the current banking stress assessment, which is that to me, it's not just about rising rates. It's about the fact that rising rates are also slowing down parts of the economy. So if you look at the banks that have failed, it's in the tech sector affiliated banks, it's in the crypto affiliated banks, and it's in the commercial real estate affiliated banks. Now, of course, commercial real estate problems are linked to working from home and them not likely to be able to generate the same revenues and rents as they have in the past. And the last point, I absolutely want to fully agree with John that sometimes it's a crisis of confidence when it comes to banking. If you have to be the first bank in the market that's raising equity, that's basically the kiss of death. Okay, this is basically a sign that
you look desperate.
Yeah, you're really desperate. You're doing it midweek without much planning, right. Saying, "Oh, we've just bled $2 billion in a day, trying to liquidate our securities. This is not going to work." You need to really plan for these things ahead of time. So when the stock of uninsured deposits is very large, if you have been treating them as though they are never going to fly, I'm sorry, but it's really too late. When the tide turns, as John pointed out.
I agree. How hard is it to move money out of a bank today? If you're the treasurer of a business, you can, in fact, initiate a wire transfer on your iPhone. You can do that in most places. And so I think that technology has reduced the friction. It's not as if they had to call the banker and say, "Hey, I want you to wire all my money out," and have the banker talk to you and say, "What are you doing?" It was just gone. So that is a little frightening.
Yeah, and if I could just quickly add one anecdote to this, our dean, the dean of our business school, Raghu Sundaram, he texted me on the day of the run saying, "Oh, this reminds me about the fact that my daughter who works at Goldman Sachs, has never physically visited a bank. She has only banked through her mobile phone."
Yes.
How about that? Jim, from your global data officer, what is it that you see on the global market that's affected by this banking stress?
So I'm going to talk even a little broader than the banking stress, because there are a couple themes in the banking piece that we just talked about that I want to kind of pull on a little bit. So one is and John just mentioned it, the fact that Silicon Valley Bank, a piece of that was unprecedented run on a bank fueled by social media. And how many times in the last 4 years have we heard unprecedented as a word?
Black swan events happen every day.
Going on in the world. So the fact of the matter is the world is changing at an ever accelerating pace. And if the things that the company I work for has to think about is certainly this banking sector and the broader economy. All of that impacts both our own investment positions. It impacts our clients. We insure a lot of these banks. A lot of them have directors and officers insurance with us. So if they're going to get sued, we're going to be in the middle of that. But we also were trying to learn from these things and provide products and services back out to the greater economy so that in this ever-changing world, we can continue to transact and have profitable livelihoods and businesses in society. So pivot that from the financial sector that we just talked about and go to things like climate change. And every year, and in September, I'm sure there'll be another one, there'll be a big storm. And we'll all remember that, wow, there's more storms than there ever were before. And last September with Hurricane Ian, that was unprecedented. We actually saw pricing change in the reinsurance market more than we've seen in my colleagues' careers. So what that means is that it is really, really hard to make any profit on anything on the coast of Florida anymore when it comes to insurance. So if you live there, you may know that because you're paying for property insurance that's amazingly expensive. But if you're doing business there, the government's having to subsidize a lot of it to even get insurance companies to participate there. So that is a challenging situation for the world because we built in places and then suddenly the world changed on us. Geopolitical environment we're in. Whoever thought that we would be more in Europe at the level we are now? What if that takes off in Asia as well? So these are all things that are going to completely alter commerce and the way that the balance of trade works in the world. We're already seeing lots of changes on, businesses' relationships with China. And then the last one, I'll throw out two more examples of risky things emerging in the world right now. One we hear about a lot, but there just hasn't been a big one lately, cybercrime, which I would argue, by the way, crypto has encouraged and actually enabled. But cybercrime is a huge issue. And all companies in the world now are on the internet. All their data is on the internet. That's a significant risk that we as a society and we as an industry have to be able to protect. Otherwise, we can't transact securely, and there's no confidence in the way that the way that money moves around and the way transactions work. And then the last one, which is the big buzzword of the last 2 weeks in my life, is this idea of ChatGPT. If you watched 60 Minutes the other night, you may have seen that. If you watch Terminator, it's getting ready to happen if you ask some people. But, this idea that artificial intelligence is going to change our lives in the next 1 to 2 years, not in the next 10, is suddenly becoming a point of view with some merit. And while that's an incredibly exciting opportunity for the world and for how we transact business in large financial companies and other companies, it has enormous risk with it. And so that has to be really well thought out in terms of how we approach that in society, how we regulate it, and how we let Silicon Valley go in a capitalist society and make sure that we still have the lead in the world where we think we should, but not let things get out of control. So those are just some general perspectives I'll share with you guys on risk that are emerging in the world that we need to manage.
Thank you, Jim. So I'm going to ask our two bankers here about the different financial sectors and how they were impacted by the banking stress and what's going to happen to the economy in these particular sectors. So I'll start with Mike.
Well, I think that probably this discussion needs to be qualified with what are our public policy leaders going to do in response to this, because they feel like they need to do something. So every time there's a banking crisis or banking stress, we end up with more regulations and more requirements. And that's been a dragging effect on the banking industry. In some respects, good, in a good way that it's helped improve risk management practices, but in other respects, it's stifled economic development. When George Morgan taught me, there was 30,000 banks in the country. Today, there's 4,500 banks in the country, and they're polarized generally in size. You have the mega banks, right, the city banks, Wells Fargo's, J.P. Morgan, and so forth, and then you have community and regional banks, banks like John's and smaller. And most of your closely held businesses and family-held businesses bank with those smaller banks because they're in their community and they understand the business, whatever the unique attributes of it may be or the people may be. And so what we've seen structurally over that decrease in the quantity of bank charters, which historically was a strength of the U.S. economy, is that it's putting stress on the ability of small businesses to obtain access to capital. So our public policy leaders are talking about increasing capital requirements on banks, talking about increasing liquidity requirements and so forth, they're trying to diagnose this problem prematurely and come up with a prescription prematurely. And so my fear is that this is definitely going to contribute to the slowing down of the economy, whatever it is that they come up with. The truth of the matter is that as a result of the global financial crisis, we learned a lot about credit risk management, right? That was a credit crisis, and it was in isolated sectors. And what we did not do is adopt the same kind of credit risk management or risk management principles to deposit and funding risk. That is what really needs to be applied. And left to their own devices, bank leadership will figure that out. And they already have. A lot of them have known it for years, that we can't be over-reliant on volatile sources of funding. And so I think that the effect is there will be a further consolidation in the M&A, and unfortunately that's going to be negative for small and entrepreneurial businesses. The economy will be good, the banking system will be fine, but I hope that our public policy leadership doesn't go overboard.
I agree with Mike. The current stress testing for banks, which is much more extensive, the higher up the scale you go, is sort of fighting the last war. Bank stress testing generally contemplates the ability to stress the capital base of the bank to withstand the impact of credit losses. Yes, there's an interest rate shock concept, but nothing of the magnitude that what we just saw. Bank stress testing does not contemplate a run. For example, Atlantic Union Bank, uninsured deposits are in the low 30 percentage point. If every uninsured deposit in the bank left tomorrow, yes, we have the liquidity to cover that. We would be fine. If we sold every security in the entire bank tomorrow, we would still be well capitalized by regulatory standards. Not everyone could say that. So I think these are going to be sort of the stress tests that will now come into play. But they shouldn't go overboard as a result of a couple of fringe banks that were executing non-traditional strategies on unstable deposit bases and assume that that's true for the rest of the industry. It most certainly is not. I will say that all of this is going to back banks off from lending. The liquidity is getting tighter. Banks will be more cautious, and the industry will do some of the Fed's work for them in terms of slowing down this economy, which is not entirely a good thing. I call this credit rationing, Mike.
Yeah.
We're seeing anecdotal evidence now of banks refusing to lend in certain cases, particularly around commercial real estate. And I haven't seen this since the Great Recession. So credit will become scarce for a while. That will slow down the economy.
Let's turn to the next generation. Let's ask Lauren what her experiences have been managing BASIS, which is the student-run endowment for Virginia Tech. And I think you have, what, $5 million in there to manage from the foundation? Yeah, so tell us first a little bit about the organization, how you make decisions, and did you have anything in Silicon Valley Bank?
I will say yes, and then I will go into the BASIS description just to keep you guys hanging for a little bit. BASIS stands for Bond and Securities Investing by Students. So we do invest $5 million of the endowment in bonds on behalf of the Virginia Tech Foundation. Our portfolio consists of corporates, sovereigns and supranationals, and treasuries. In the credit selection process, we kind of do rigorous analysis on industries, companies, and bond specifics. We look for relative value in those credit selections as well as in duration. We position our portfolio on the yield curve to benefit from rate movements. It's a really good opportunity for all the students. I think we all come out of it with a well-rounded knowledge in fixed income in the markets, as well as also a well-rounded skill set for any career path that you're going to go into. We did hold SVB. I don't know if Dr. Morgan wants to add anything more on the credit selection process.
No, I think that pretty well covers it. I mean, it's a pretty extensive process that the students go through. It's maybe drawn out on a longer time frame than what most of you are used to doing, but the students have full course loads that they're working on, and so it takes us a little longer to get through the full process, but they do an industry analysis, as she said, company analysis, bond analysis, so it takes quite a bit of effort on their part to parse through even once they define who the company is and what the bond will be. And before that, there's a long process of trying to select and try to keep our portfolio diversified too, even within a sector like the financial sector, so that we're not all concentrated on the largest commercial banks in the country. They've made an effort to diversify out of sort of the common suspects and trying to get into other parts of the financial industry.
So George, how closely do you guide the students' decisions?
Boy, that's a loaded question. It's their decisions.
That's good.
I'm the advisor, and I'm just trying to keep them within the bounds of what our investment policy is. We have a very specific investment policy, and basically, as long as they stay in that policy, I'm not going to veto any decision that they make. It's up to them, and the responsibility and the accountability is with them. Now, if they're doing something crazy and wanting to go into cryptocurrency, that's not in our investment policy. So I would step in and say, no, we can't do that. But otherwise, they do a good job.
So Lauren can say, right, this bond it's an investment grade bond, right? I mean, so the investment rating agencies had this bond rated pretty well.
They did. It was split rated, I think A3 and BBB.
Yeah.
It was, Dr. Morgan may have disagreed with our investment decision on that, and he might have been right, but.
I didn't hear you. What did you say, Lauren? I mean, he's retiring. He needs his gift. Okay, yeah. All right.
No.
Yeah,
Right.
of course.
Correct.
Yeah.
Ask Silicon Valley.
Yeah.
So how did the students react when this happened, and what did you do to recover from it?
Well, we were all on spring break. I will put that first. Dr. Morgan was out of town, and the entire exec team was out of town, so it was kind of a tricky situation, but we all kind of jumped to our feet and went into analyzing the company and the bond. So on that Friday, when it got downgraded to high yield, we are an investment grade fund, so there was no way we're able to hold it anymore. So the question went from do we sell to when? So over the weekend, we go into super in-depth analysis on trying to estimate the price of the bond given bankruptcy proceedings and what we would get out of a liquidation and what the hedge funds would think it should be priced at. And then from that, we gave our little ballpark and went into the trading process. And that was a whole problem in and of itself. We only have investment grade brokers because, what do we need a high yield broker for an investment grade fund? So that was an hours long process trying to find a broker that would trade with us and who could trade our bond. Lots of alums were helping us out, so shout out to you guys if you were on the phone with us. After that, we were able to find a broker and a counterparty to sell the position to. And some lessons, I think, to come out of that, aside from having a high yield, trader to back us up in that way, was probably the difference between operating and holding companies in the banking sector specifically. I think the role of the FDIC is huge in that, and I think it's something that we don't give enough credit to, and that if in the event of a default, that operating asset, the biggest asset of the bank, can be taken away in seconds. So really, when we're holding the holding company, that all the assets are pretty much gone. So trying to figure out what's left, how do we get compensated for that risk that we took in the initial investment decision, I think is the biggest thing on that front. I think what was important as well was the FHLB-like borrowings. That's something that we didn't know was a red flag until after it happened. So after that process as well, we went into all of our other holdings and tried to figure out, are these a risk? Should we be looking at the entire financial sector? There was Charles Schwab, I think, at the top of the list. So we had to make sure, if we're in any asset managers or anything like that, that we would get that off our books.
So
Lauren, may I ask, what was the realized price on the sale of the security?
I don't think I'm allowed to answer that.
I'm just curious. Less than 10 cents, I'm going to guess?
No,
No.
much better than that.
Better than that? I don't know. I'm just curious.
So this was kind of the curiosity. So I think what we learned is that what Dr. Morgan has said all along about OpCo and HoldCo was wrong. So because we were actually quite a bit better off by having the HoldCo instead of the OpCo. Because like Lauren said, the FDIC just grabbed that out from under, and if we had had a bond in the bank,
Right.
it would have been zero.
The holding company in this case had other assets.
They had other assets, and so the bond. Again, we're on spring break, and we're trying to look for the price of the bond, and it's still trading. Why is it still trading? Friday, Monday, it's still trading. It's because it was the holding company, and that hadn't gone into bankruptcy yet. So we were able to sell it before it went into bankruptcy, and it may do even better. It may actually end up back at where we bought it.
Good heavens!
But we can't. But we can't buy it. We can't hold it anymore.
Yeah.
So.
Yeah, our joke was we'd come to the court proceedings up here and get our assets back.
Right.
Lauren, as someone who's done problem loans and workouts early in my career, I would suggest, painful as this is probably the best lesson in the history of basis. You learned a lot of things. Bond ratings are not homogenous. You can't simply say it's good because it says BBB and that assume that all BBBs or whatever it was are the same. Markets don't help you if markets aren't operating. If there's no buyer, it's worth nothing. And then all of these sort of unexpected events, if it never occurred to us from a contingency planning standpoint that we might actually have to sell something that's not investment grade, what would you do? And so these are the sort of scenarios that we live with, ourselves. So I would say, this was a good lesson, and you learned a lot as a result of it.
Yeah, and I think kind of back to the LTCM, liquidity dries up in a crisis.
Yes, it does.
You have a position and you're trying to liquidate it, you may not be able to.
Right.
Even though it started out looking like a great deal with all the Nobel physicists at LTCM, in a crisis, you're going to have a big problem liquidating. And fortunately, we didn't have that big of a problem in liquidating. It was a bit of a struggle, but Mike Kosciuszko knows distressed debt trading is a different animal.
All right. Well, now that we've talked about the issues, what can we do to prevent something like this happening again, or reduce the stress on the banking sector? And this is for all of you, but I'm going to start with Viral.
So I think one thing that needs complete rethinking is the stress test apparatus, as John was mentioning. It might seem strange, but in the stress test, you get a recession in the current scenario that the Fed employs for the banks, and actually interest rates go to zero in the stress scenario. So here we have the Fed, which is like, raising interest rates by 4% in less than 15 to 18 months. And actually, the scenario that they are stress testing the banking system to is actually one in which the rates are going to zero. So you can see what this leads to. And I think it's a little bit of this cognitive issue of continuing to fight the last war, thinking that, it's again going to be a credit problem that's going to arise. I'm not saying that scenario isn't a useful one. I think that has ensured that there's enough capital in the banks, especially the ones that are being stress tested the most stringently. But it illustrates that supervising and regulating a banking system well is a little bit beyond just designing rules and then applying them over and over again year after year. And I've been thinking a little bit about how the process could be improved. And one simple idea could be that maybe the Federal Reserve stress testing system should actually have an internal, perhaps even a consultative process where they think about what are 1, 2, or 3 new stress scenarios that we might have to contemplate that we haven't thought about before. I think this goes back to one of the earlier points, which is that there's a risk that the risks are changing. And I think that is the hardest to actually deal with. Because it's easy to know what happened in 07, 08, simulate that, and prepare the system for that war. And I think it is important to fight the last war. I think I don't want to underestimate the importance of that. But simultaneously, you need to think about what are the new risks on the horizon. I think we talked about mobile banking. We talked about, we talked about climate manifestations getting worse than what they have been. And I think it's worth thinking through that. I think in industry, there is actually a nice concept in the bank senior management, which is a reverse stress test, which is you ask yourself the question, which scenario is going to cause my bank possibly to come under severe stress? And I think the Fed could actually ask these sorts of questions, which is, what is a scenario in which my banking system right now could possibly go under stress? And when I did that exercise, I came up with one answer. It may not be the right one, but I just thought I'll put it on the table, which is that maybe the scenario we ought to think about is one of stagflation, which is you kind of have relatively high inflation, even if it's coming down at a rapid pace. It doesn't seem likely to me that in the next 1 year we might get sort of close to zero interest rates. We are likely to see interest rates which are somewhat higher. And for the variety of reasons we've been discussing, there is banking stress, there's stress in the tech sector, in commercial real estate. So we might get something that looks like something like a mild recession at a relatively high interest rates than what we were used to seeing. It's a scenario that we haven't seen for a while. I think we saw it in 70s and 80s before Paul Walker actually brought the inflation down. But we were in a stagflationary environment at that time. And it seems to me that we should at least put it on the table, which is, are our banks are resilient to a stagflation scenario or not? That would be my way of approaching the banking system right now if I was in the central banker's shoes at this point of time.
Thank you, Viral.
Good, yeah.
Anyone else want to jump in here? Jim, you want
I
to
just
jump in?
I want to echo one thing Viral said that really rings true with me, which is we've got to use moments like this to remind ourselves that a lot of what's out there right now for setting the capital requirements and regulatory requirements is based on prior information and past data that may or may not apply to the world we're heading into. So constantly challenging the assumptions within these models and what is actually happening in the world and are they still valid is critical. And so I'm hoping that the people in the banking industry as well as the people regulating the banking industry use these moments to remember that and constantly reevaluate and reassess the macroeconomic environment and whether or not those models are valid.
Mike, you want to comment on that?
The sun will rise tomorrow.
Yes.
And
Are you going to sing to us, Mike?
I am. It's you always have to learn from these challenging situations, and I wish I could remember the statistic, but if you go back and you look at the number of generationally successful companies that were started in the aftermath of the Great Depression in the 1920s and 30s, it's just staggering, the amount of wealth that ensued, and that was a very, very difficult time. I ran a commercial bank for 20 years, and the best opportunities we found were in very difficult markets. Some of the best businesses are started in difficult times. So all this will get sorted out. Bank managers need to learn that they have some of the same basic business risks that some of our customers do. These banks had some basic customer concentration risk issues that bankers lecture their clients about. And so we're paying attention and we're learning, but there are opportunities that will emerge from this. And like Warren Buffett says, don't bet against America.
That's right.
I agree with that. And I would add, it's a good reminder that the American banking system is built on confidence. And we just had a taste of what happens when there's a loss of confidence. Imagine if there were deep fake videos and misinformation being wildly spread on social media by some foreign power trying to disrupt the American economy. A good way to reverse stress test it would be call into question the integrity of the American banking system. You want to disrupt the economy, do that. So I do think that that clearly there'll be different forms of stress testing. I will say that at the risk of sounding like a cranky banker, that in the end, the banking industry is dealing with the public's money. And we operate with the privilege of a bank charter and FDIC insurance. A bank is not a casino. So these fringe strategies, this cryptocurrency stuff, some of these banks that convince themselves that they're not banks, they're actually financial technology companies that just happen to be a bank, which is completely backward because in the end, if there's a blow up, it's the people's money, right? And it's the confidence in the system. So I just think prudent risk management does matter here. These are not casinos. But the American banking system is resilient, and there is no banking crisis. Yes, it's stressed. We'll learn from this, and we'll move on.
George?
Yeah, I think I want to remind people that in part, I think regulation is what got us here, sort of bad regulation, and people who are talking about layering on more regulation, I think we have to be very skeptical about how that works and where that's going. I mean, you mentioned the stress test. If Silicon Valley Bank had been subject to the stress test in 2022, in March of 2022, the stress test was that the 10-year Treasury rate goes from 70 basis points to 100. Big increase. and that the CPI inflation peaks in 2022 at 2.3%. This is the Fed saying this is a severely adverse scenario. It peaks at 2.3 and goes down to 1.4. So it's sort of ridiculous in terms of the stresses that they're putting on the system, that they're supposedly putting on the system. And then there are the Basel requirements that, kind of to John's point, that there is no interest rate risk capital charge. It's all on credit. So right. Sure, if you're a banker and you're trying to avoid the capital charges, you're going to take less credit risk and you're going to put a lot of your marbles on bonds. Interest rate risk in bonds, yep. Long duration bonds, so you can get a higher return. So that's just an incentive that's set up in the regulatory system. And then, John, I wonder if you would comment on FASB and hedging and held to maturity.
Yeah, so as a bank, you have, this is wonky bank accounting. The bankers didn't invent this, FASB did. When you hold securities, you have to choose. Do you code them as available for sale, meaning you can sell them at any time? In exchange for that, you have to mark them to market on the balance sheet, and it hits your tangible capital. Not regulatory capital, but tangible capital. It's very clear. It goes up and down. That's what you would expect them to be doing. Or, and you can do both, you also have as a choice held to maturity, which means you cannot touch them. You must hold them to maturity, but you do not have to mark them to market. Silicon Valley Bank was sitting on $15 billion of unrealized losses and their $90-some billion of held-to-maturity securities. That was not evident, although the information was there if you dug for it. Had those been liquidated, they would have been deemed insolvent. But why would they ever sell all of their holdings? So I think that this is not good. Banks play games with it. We hold 77% of our bonds and available for sale because we think it's a bad idea to choose held to maturity because you're tying your hands. You sell one of those bonds, you have to mark the whole thing to market. And I think that would instill a discipline not to go too far out on the curve, not to put too much in the way of bonds in. The banks didn't ask for this, in my opinion. This is a FASB convention, and I do think it needs to be addressed. Quite candidly, just have all the bonds available for sale and have them marked to market. And then if that would create concern about, better not have too much of this, because if interest rates run up and we have all these unrealized losses, it'll create capital problems. That's my opinion.
Another wonky issue there is hedging. I don't know if you want to talk about that, hedging that portfolio.
Sure. I mean, we use some balance sheet hedging. Silicon Valley Bank did have hedges on the balance sheet, which they allowed to expire, presumably because it cost money. And so one could argue that Silicon Valley made a massive bet that not only would rates not go up, that rates were going down. And therefore, that would have been a good investment. So I do think that you have to contemplate from an asset liability management standpoint, these interest rate shocks, not 50 or 70 bips movement in interest rate, but a couple of hundred. And hedging is a mechanism that helps to protect you from that. So banks are fundamentally a risk management exercise. This is asset liability management. Bank failure is really an interesting thing, something I wouldn't have really contemplated. Asset liability management was sort of like way in the back room. It's important, but never would have thought it would break a bank, and here it did.
Yeah, I want to especially echo one thing John just said, which is that, so when I was a deputy governor at the Reserve Bank of India, we were running into similar asset liability management issues, especially with our state-owned banks who were very lazy on risk management, and you can imagine why, because they don't have a shareholder that's really kind of holding them accountable as well as a private bank faces. And one of the things we observed was that when you have securities in the available for sale, because the fluctuation in the valuation enters the P&L every quarter, like in the tangible equity calculation, it immediately sensitizes the management to the risk management of that fluctuation. But the moment you put it into HTM, you are not making it flow into the P&L of the bank. And that immediately eliminates the incentive to think about that risk and manage it in any way. So I'm so glad to hear what John has said, which was sort of our guiding principle when we were regulating the banks, that we've got to mark these assets because that's the way to sensitize the management to the fluctuations in their P&L.
Any other comments from the group here?
Going to be studied for a long time.
Yes, books will be written about this.
Yes.
Future students will study it. Some of you may become PhDs and do your thesis and your dissertations on it at Virginia Tech. Remember, what happened to SVB was panic. They didn't sell their held to maturity. They had over $100 billion of bonds. They sold $21 billion of bonds, which is all they could sell and available for sale. That's all they had in available for sale category. Took a $1.8 billion loss. Why did they have to sell their bond portfolio? Why didn't they just leave it alone? Because they were getting crimped as this bubble, which is what their deposit base explosion or growth was, began to recede. Interestingly, the weekend that SVB failed, the Fed came out with something very clever. It's called the term liquidity facility, allowing banks to borrow 100% against the par value, not market value, par value of their government guaranteed securities, 100% on the dollar for a year, to avoid this very scenario where they might have to liquidate bonds in a stress situation and take massive losses. So I don't see anything else right now that looks quite like this. Other banks were stressed that were perceived as having some Silicon Valley or Signature-like characteristics. First Republic, who was the third highest percentage of uninsured deposits in the industry? First Republic. That's a good West Coast private bank. They deal with wealthy people. Surprise, wealthy people have a lot of money in the bank. There was nothing wrong with them. They were a victim of a drive-by shooting, but they were targeted. People began to grow concerned, pull money out, and that's why you've been reading about them in the headlines. They haven't failed. So I don't think the contagion, which is what this is that's the concept, will this create a contagion and begin to spread throughout the system? I think the Fed arrested that. I also think to some extent the FDIC was smart to go ahead and pay 100% on the dollar. Remember they did that. The FDIC guaranteed 100 cents on the dollar. It's a complex thing to pull off. They can't do it on their own, which also calmed the markets down, which sets up a debate that will run for years about the future of FDIC insurance. Conversation for another day.
Equity market, I would also add that equity markets are very efficient, and so it did not take very long at all for the institutional buyers of bank stocks to incorporate a complete mark-to-market, doesn't matter whether it's held for maturity or available for sale, against the tangible capital of the bank.
Correct.
And so the companies, there are some companies that are technically underwater, but there's very few of them, and they're deep in the red.
Correct. And someone mentioned Charles Schwab Bank. Why? What does that have to do with anything? Well, Charles Schwab Bank is sitting on massive unrealized losses in their bond holdings, and they hit a list. Is Charles Schwab Bank going to have to sell all of those bonds now and wipe out their tangible equity or their capital? I don't think so. So I think that this is the sort of concern that starts going around. People are trying to figure out what else looks like this. I think this one has been calmed down.
But there are several that have had tens of billions of dollars of borrowing from the Federal Home Loan Bank.
Mm-hmm. It's the ones, and it's
liquidity reasons.
And I can tell you who they are. It's First Republic, it's Western Alliance, and it's PacWest Bank. These are all the banks that were targeted as having SVB or Silicon Valley-like characteristics. The Independent Community Bankers Association of America, which is the association of community banks, banks under $10 billion in assets, are reporting no issues. The Mid-Sized Bank Coalition, of which we're members, banks from 10 to 100 billion, the diversified banks, which are most of us, are generally reporting no problems. We've had no problems. So where are the problems? They're actually in a very small number of banks. There are some business banks that have been stressed. I won't name names, that have seen some degree of deposit outflows, but we'll see if I'm right or if I'm wrong. But as banks are now releasing quarterly earnings, I think what you're going to see is deposits did not massively flow out into the too big to fail banks seeking safety. Deposits have gone out seeking higher yield. But I think that the H8 data, which is the reporting the Fed puts out periodically, are showing deposits coming back in. So I think that you're going to find that the American banking system actually is resilient, and I think is held up okay.
But John, as you said before, it's built on confidence. And George, just because a bank is borrowing money from the Federal Home Loan Bank or the Federal Reserve is not a death sign in of itself. And if you want a fundamental lesson in bank finance, watch It's a Wonderful Life, the famous movie.
That's exactly right. That's what a bank run looks like.
And that's what a bank run looks like. And no bank in the country has enough cash to pay all
the money is not in the vault.
So
it's not where the money is.
The system is built on trust and confidence, and everybody's money is invested in each other, so to speak. So the sun will rise tomorrow.
Yeah, I think one thing I would stress, though, and I think it just goes back a little bit beyond the banking, I think my concern is about the sectors that had either grown very fast post-pandemic, like the tech. I think I've no doubt at my end that this was a bubble. It was just crazy valuations in equity markets in a very short period of time. Anyone could get any funding to do a startup in the tech at that point. I think there's got to be a slowdown there. I think there was just too much froth. And I think commercial real estate is undergoing a very fundamental transformation.
I think it is.
Because of work from home, even like New York feels sort of back, but commercial real estate of New York is not back up. Right. Because, the occupancy is just not going to be what it used to be. So my sense is as time goes by, I'm more concerned about these sectoral stresses playing out. And then there will be smaller banks which are very exposed to commercial real estate because that's been historically their bread and butter.
Now we're back on credit stress testing, which matters importantly.
Exactly.
And by the way, when you read about these high-rise office buildings that are bankrupting in places like New York, Washington, D.C., that the owners are walking away, as we would say, turning in the keys, This is highly likely not a commercial bank loan. It is highly likely a commercial mortgage-backed security. It's an institutional lender, non-recourse. Guess what? Most of the time, we require our borrowers to guarantee personally some or all of the debt. They do not hand us the keys because they know we can take them to court. Most smaller banks do that. So I think that there's a bit of confusion, too, when you read about commercial real estate. I am worried about high-rise office buildings, but guess what? We finance none of those. Most mid-size or smaller banks finance none of those. That's generally in the institutional market. So that's kind of like a shadow banking system concept. And there will be losses there, but that's not the public's money. That's not your grandmother's deposit that's at risk.
Yes.
Do you think now is a buying opportunity for some of these regional banks, small, mid-size? I think there's more in the fall.
It's so funny. I had an investor call me the other day, and I said, are you wanting to know whether you think banks are now on sale or whether banks are not yet on sale? And so that's kind of your question. I'm not going to speak. I guess you will have to do your own analysis on that. But if you look at, actually, I know the perfect question. I know a bank investor, Mr. Mike Clarke.
That's right.
Pass.
Mike, bank stocks are on sale big time, but yes, you need to be eyes wide open. I mean, there is probably a little more of a downdraft. We expect there to be a little more downdraft in bank valuations, owing mostly to revisions downward in earnings estimates and maybe a little multiple contraction, but we're pretty close to the bottom, and the travel up will be quite rewarding. But be careful what you buy.
Yes.
I think John was speaking to this, but it's a question for the whole panel. You talked a little bit about how at the end of the day, Silicon Valley Bank was sort of a simple bank run, but it was accelerated by social media.
Yes.
I'm just wondering, are there any other areas of interconnectedness between social media and the financial system that are also cause for alarm for you? And are there any ways to safeguard against some of those risks?
The spreading of misinformation should be concerning to all of us, and not just in the financial system. You see it in the political sphere. Who knows, what's at risk there? So I think that is definitely a concern. Part of what I've been asking myself is, what else is weird that goes on in the banking industry? There's a concept called banking as a service. I'm not a fan of it. Banking as a service is typically where smaller banks, not exclusively smaller banks, will rent their banking charter to financial technology companies. Raise your hand if you bank with Chime. Anybody? No one uses Chime. I'm actually glad to hear that. Do you know what Chime is? Do you recognize Chime?
Yep.
Is Chime a bank or an app? Chime is an app. The state of California made them clearly say, we are not a bank. They're an app. So when you put your money in Chime, what are you doing? You're funneling it through to a handful of small banks who basically pay Chime. And so they're farming those deposits out. Chime gets paid a fee. The banks get funding. If there's there are lots of arrangements like this. I do worry about these fintech companies that are accessing banking powers because banks are renting their charter out. So here we go again. Your FDIC insurance, your grandmother's money is not really there to help empower a fintech company to make money by paying some little bank to tap into the Federal Reserve System. That's really not the point. And so I just worry about this. Is there going to be some blow up? And are we going to be answering questions from our customer because there's some blow up at so we've already seen it in cryptocurrency, where cryptocurrencies were talking about their bank partnerships and FDIC insurance, and some set of people think that their cryptocurrency was somehow insured by the FDIC. So I worry about misinformation.
Okay, this one over here.
You talked about unrealized losses and the role it played in this. Just curious, Jim brought up other emerging risks. What similarities do you see with that related to climate risks and things like climate-adjusted PDs and kind of the repricing of assets that's going to come with climate risk? Anyone?
I have a view, but Jim, do you have a view on this one since you're an insurer?
Jump first, and then I'll.
I can tell you, if you recognize, from an ESG standpoint, publicly held companies are required to provide Scope 1, 2, and 3 emissions, if anyone knows what that is. Scope 3 emissions for a bank means we have to assess the carbon footprint of our client base. And you will eventually see lots and lots of sophisticated looking information that tells you what that is. But what you need to understand, because we're living it right now, is these are algorithms and estimates. They are best guesses. We don't actually know. We are assessing this. From a bank regulatory standpoint, right now they're mostly focused on safety and soundness issues. Norfolk, Virginia is the #1 city on the East Coast in terms of most susceptible to sea level rise. What does that mean? And so we have to think about it absolutely from a risk management standpoint about climate change, flooding, fire, drought. And then you also have to think about second order events, the electrification of vehicles. Do you want to be financing a convenience store that's reliant on sale of gasoline to pay you back in 5 years, 10 years, 20 years? So it's a big issue, and it's a very real issue for us.
But in an efficient market should price that in, I would suggest, right?
But I think it's also kind of a longer term play.
Yeah.
But we are focused on this.
I mean, the most obvious example is I own a home in that region he's talking about. My insurance has tripled in the last year. Thank you.
We don't do American homeowners.
It's a good question.
Don't blame us. But.